Hey everyone, welcome back to the channel. Welcome to another video. Thanks for being with me for another one. And especially as we do this walk and talk, it's been a while since I've done one of these, and more importantly, talk a little bit on the money side. Now guys, before we jump into things, especially in this particular topic, which is going to be a good one for today, make sure you go ahead and give me a like for the video as it helps the channel grow. Go ahead and subscribe to the channel and turn on your notifications so you're notified when I upload new videos to the channel. And lastly, of course, make sure you share this with a family member or friend because they're going to really like this one, especially since it affects a lot of people here in the United States, especially if you got a job. And nothing wrong with that because I got one too. Oh, and one last thing. A lot of people have been hitting me up and asking me, hey, how do they get in touch with me for coaching calls, especially from a financial perspective? Links will be in the description, and possibly I'll even put something in the comments as well. I'll pin it there most likely, but definitely you'll find all the information that you need in the description. I keep everything up to date there, so go ahead and make sure you check that out. All right guys, so let's talk about it. This is a controversial, I don't know if it would be controversial or not, but a couple of years ago, I decided that investing in a traditional 401k made absolutely no sense. And I never decided to invest in it, and I don't think you should either, but there's some reasons why. And let's talk about it so you can understand why I decided not to invest in a traditional 401k, and possibly why you shouldn't either. So traditional 401k, I don't really like confusing a lot of people, right? We throw all these terms out, so let's break things down to its basic, so that way you guys can understand what I mean. So if you work a job here in the United States where I'm located, typically you can save for retirement, and you'll have companies that offer you what is called a 401k. Now, most companies do what is called a traditional 401k, meaning that money goes into the account and you don't get taxed on it, but you take a tax deduction. And so the idea is that you take that tax deduction, and later on in life, when you're ready to take the money out, you pay taxes on all the growth that's in the account, and also as well the money you put into it because you took a tax break earlier on. All right, so you guys now know what a traditional 401k is. The other 401k option that I see mostly a lot, and especially from a W-2 perspective, again, that means you have a job, you earn income through a job, is a Roth 401k. And a Roth 401k, all that means is you're not taking a tax break today. You're literally paying taxes on the money that you earn. And then what happens is you start investing money into this retirement account. And then as the account grows, everything that is in there from a growth perspective is not taxed when you pull it out. And then also as well too, the money that you put in is not taxed either. Why? Because again, you already paid taxes on it. And that is the benefit of a Roth 401k. All right, so now that we have the 401ks, the definitions out of the way, let's talk about why I never decided to do a traditional 401k, meaning, hey, give me the tax break today. I'd rather pay less taxes today than pay less taxes in the future. So let's talk about reason number one. So reason number one why I never decided to do a traditional 401k is because when you get to retirement, that equals higher taxes for you. Retirement equals higher taxes. One of the things that I often hear about why you want to go ahead and invest in a traditional 401k, especially in your working years, is because in your working years, this is where you're going to earn a lot of money, or you should earn a lot of money, and you're going to need every single tax deduction possible in order to help you bring down how much you pay in taxes. So essentially, you can think about it as if you're going to have various tax deductions while you're working, and that can be dependents. Let's say you have kids. Let's say you buy a house during your working years and you're paying interest on the mortgage. You can leverage that in order to offset how much you pay in taxes. Or let's say you have work-related expenses. Those work-related expenses, you can use that in order to leverage that as tax deductions to bring down how much you're going to pay in total taxes. Now, again, those are just some examples of tax deductions during your working years. And the idea is that you can leverage that on top of a traditional 401k in order to bring down how much you are paying in total taxes during your working years. And then when you get to the end of the rainbow or your retirement, that is when you are going to not have as many expenses, those deductions go away, and the idea is that you're not going to need as much money in order to retire because you're not spending as much, right? You don't have Those kids, they should be grown and they should be out of the house. The house should be paid off by the time you hit retirement. I mean, you have 30, 40 working years. So you really should be planning in order to get rid of that mortgage. And then of course, if you take that last example, which is your work expenses, well, you're not working anymore. So that drops off too. And again, you're not going to be spending as much money because you're not working. You're in the retirement life at this point. But here's the problem that I see a lot of times with that. That assumes that when you get to the retirement age, you're not going to want to do anything from a retirement perspective, meaning that your lifestyle is going to be less than how much money you were making during your working years. And let's face it, that is unrealistic. No one goes into retirement and says, hey, I'm going to spend less money than what I was making in my working years. If that is the point, then what is the point of retirement? What are you saving for? Right? Most people, they get to retirement and they say, hey, I want to travel more. I want to spoil my family in the sense of maybe I have some grandkids and I want to set up educational accounts for them. I want to buy them extra gifts. Maybe you decide, hey, I want to get a second home in the deserts of Arizona. I don't know, whatever you decide to do there. The point is you're going to be spending a lot more money in those retirement years. And this is how I know. So let's do an example here and let's take a look at this mutual fund calculator that I have on screen here. And this mutual fund calculator is going to tell us how much money we're looking to make in our mutual funds as an example of what we can have in our retirement years. So let's say we have somebody who is at $58,000 per year from a household income perspective. And that person, single filer, is making $58K and they decide to save away 15% of their retirement. Now, of course, I argue that you need to be doing more, but let's just say you're doing 15% in retirement. So I'll save you guys a little bit of the math here, but 15% in your retirement equals $8,700 every single year that you're putting away in retirement. Now, if we take a look at the calculator again, and you see, hey, how much are we putting in every single year after that? Let's assume that we're gonna keep the $8,700 and continue doing that for 30 years until we get to retirement. Let's say your rate of return is 10% on that mutual fund. And let's say you have an expense ratio of 0.04. And if you're asking me, where can I find that? Trust me, there's a lot of mutual funds out there that'll do that, and even index funds as well. So if you haven't seen it, you should probably go and continue looking because they're out there. So what does that equal? Well, as you can see from a gross perspective, we have $1.7 million. And if you factor in fees, you're looking at 1.7 on the low end, $1,711,000, almost $1,712,000 if we like to count the rest of the money there. But essentially, you got a little over $1 million in that account by the time you get to retirement. Now, let's say you're doing about 10% rate of return, which is average for a lot of index funds and mutual funds out there. But let's say that you've done that. So at 10%, you're looking at a little over $171,000 of money that's being generated per year for you to spend. How interesting is that? So are you guys gonna tell me that you're not gonna take that money and spend it at all? You're going to spend less than what you were making during your working years? I highly doubt it. You get to retirement to enjoy yourself, not to limit what you guys are doing. Hey guys, so take a look here. We got these giant excavators and tractors and all kinds of different things out here. And you're probably wondering what the heck is going out here. But this is actually the development that I'm in right now. And I'm actually going to capture this because this is an interesting time in the Florida housing market here. And I find it very interesting that I think that they're going to put in about 100 homes over here, if I'm not mistaken. That's the number. So the interesting thing that I find about this neighborhood or this development is that prices in here are in the mid $500,000 starting, and they work their way up from there. Now, if we all know Florida and you actually take a look at the average income here in Florida, it's somewhere between $60,000 to $70,000 per year. And in some of the areas that are surrounding me, the average income is a little bit higher. It goes up to $100,000. But the interesting thing is that I think that we're in a bubble here because, I mean, I just don't understand it. There's only so many folks that make over six figures, and the average income here in Florida is not that high. Remember, this is primarily a service-based state. You have a lot of, tourism, service folks that don't make, a lot of money. And so I'm wondering, where is everyone that is buying these houses? I'm not seeing how this makes sense. 5 years ago, these houses would go for 250, 300,000. Today, they're going for 500 and 600,000. Incomes haven't risen that much in Florida, so essentially you've priced out a lot of the locals and first-time home buyers. So I figured it's an interesting time to document what I'm seeing. All right, so back to our example here of higher taxes. If we take a look now and we say to ourselves, okay, so we've generated $171,000 from our $1.7 million that we have in retirement. When you decide to say, okay, well, I'm going to go ahead and spend that money in a traditional account, that is treated as ordinary income. So what does ordinary income mean? Ordinary income means that it's as if you went to work for the money. Yes, that's exactly what that means. And for folks who don't know, ordinary income is one of the highest taxed incomes here in the United States. So as I put up the tax bracket here in the United States, and especially for 2024, you can see that your money and a portion of your money is taxed as high as 24%, just because it is ordinary income, and that's how the gains are treated after you take the money out from a traditional 401k. Now here's the idea. Would you rather have your money's taxed up to 24%, or would you rather have no taxes or very little taxes? And keep in mind, when you get to that retirement age and you want to go have fun and spend some of the hard-earned money that you've worked hard for, you're not going to get to that point and say to yourself, oh no, we're going to stay below just because we don't want to spend money on taxes. No, you're going to have a good time, and of course you're going to be taxed a lot higher because, again, it's treated as ordinary income. So all that to say, in that example now, you get taxed a lot higher at the end of the rainbow when you're using a traditional 401k in order to invest for retirement. All right, so let's recap. So number one, you're in a higher tax bracket. And number two, we talked a little bit about it already in number one, but again, you are taxed higher. And I gave you a little example of how that works, right? I talked a little bit about how the money is treated, but let's break this down further because a lot of people don't realize what's inside of these 401ks, and you don't even realize how you're getting taxed a lot higher. So I'll break it down even further here for number two, and stick around for this one because you're gonna love this. So if you guys don't know, a traditional 401k, or just even a 401k in general, what is the underlying asset inside of the 401k? And for those of you who don't know, typically it is mutual fund, index funds, or the underlying investment between all those things that is common is stocks. So when we think about index funds or mutual funds, essentially it's a collection of stocks, right? Or you can say to yourself, hey, I'm going to invest in a single stock within retirement. And the idea is that ultimately you're just investing in stocks. And these stocks are treated a little bit interesting because of the account. And the account says, hey, we're saving for retirement. So essentially that is all that is to it when it comes to a 401k. That is what's inside of it. So now that you know what is inside of the traditional 401k or just a 401k in general, now that you know it's stocks, the next thing you start to ask yourself is, well, how am I taxed on this stock that I'm holding inside of my 401k? And by the way, guys, there's also something else that I will share with you about these stocks. And if you're not familiar with what a stock is, essentially when you buy a stock, you're buying into a particular company. So you have a small ownership when it comes to the company, and if the company does well and it grows in value over time, so does your stock. And that is essentially at a basic level what a stock is. And one of the other things that I will say when it comes to stocks is sometimes a stock will give you a dividend. So what is a dividend, you might be asking? Well, a dividend is when the company does well and they have profits, they can take a portion of those profits and distribute it back to their shareholders, meaning the person who bought the stock, they can distribute it back to you in what is called a dividend. And by the way, those dividends, you can take them for yourself and you can spend the money, or you can reinvest it back into the company and grow your position with the company. Meaning, instead of, one or two stocks that I may have, I might take my dividends and use that to purchase more stocks. So now I have 3 or 4. So that's an example of what you can do when it comes to those dividends. So now that you know what stocks and dividends are, now the other thing that happens when it's inside of a traditional 401k, and of course, when it's not in a traditional 401k, we'll touch on the two topics. But as I mentioned early in the video, when you have it in a traditional 401k and you get to the end of the rainbow and now you're ready to start going into retirement, you now are selling those stocks, because when you cash out in order to get your money, you are now selling those stocks, and possibly some of those stocks are producing dividends. So what did I say before? Yep, you got it. That is treated as ordinary income, meaning that you went to work for that. Now, what's the big deal in that, you may be asking? Well, at that point, you lost all the tax benefits that come with stocks and dividends outside of a retirement account. So let's break this down so that way you understand what I'm saying. So up on the screen right now, you're gonna see a chart from NerdWallet, and this chart is the dividend tax rate in 2024. And by the way, might I add, this is for a qualified dividend stock. So now that you're seeing the tax bracket here for dividends in this NerdWallet screenshot that I have, you start to see that the tax rate, and let's say, for example, you're a single person, so anywhere from $0 to $47,025, literally, you can take that money out, meaning you can take out $47,025 and not pay $1 in taxes if this money was outside of retirement account, in the sense of it's not in your traditional 401k. Now, if it's in your traditional 401k, again, you're gonna have to pay taxes on that money. And we'll talk about what that looks like. We'll do some scenarios. If we're still looking at the chart here, it even goes further. You can pay 15% on up to $518,900. So you're paying less taxes than you would on ordinary income. And again, I will make an example. And if you're married filing jointly, I mean, shoot, you can take close to $100,000. So $94,050 and not pay a penny in taxes if you have this dividend stock here. Meaning the stock is paying you a dividend and you're collecting almost $100,000, and you don't even have to pay a penny in taxes. I mean, that's incredible. And not only that too, if you take a look at the single filer, the most you're ever gonna pay is 20% in taxes. That is a lot less than any percentage that you'll have in the tax bracket for ordinary income. So if we look at the ordinary income tax bracket, you can pay as high as 37% on your money, which is insane to me, by the way. All right, guys, so now that you've seen the tax bracket for both ordinary income, and I'll flash it on the screen here real quickly, that is the IRS tax bracket. And then also as well, you're now seeing the dividend tax bracket, and I'll put that one up here on the screen as well from NerdWallet. And by the way, the tax bracket was from the IRS website, so you can see that there as well. So let's do an example so we can solidify this now. Let's do an example of a single filer who's making $58,000. What do the taxes look like for each scenario, so that way you can really see how egregious it starts to get. So we're gonna assume that we're gonna take this person's $58,000 income. We're not gonna apply any deductions to it. We're just gonna make it very simple so that way everybody can understand. So essentially what's going to happen is, and we've actually done videos in the past of this before, how the tax bracket here in the United States work. But essentially this person is going to pay a little close to $7,800, well, to be exact, $7,813. So $7,813 is what this person is going to pay in taxes, again, assuming no deductions whatsoever. And that is an effective tax rate of 13.5%. So if you go through the example of how you calculate ordinary income, you go through the tax brackets, you'll see exactly what I'm talking about and how much a person is going to pay in taxes. Now let's make the same assumption, except from a dividend perspective, let's see how much taxes a person is going to pay when it comes to dividends. And again, we're going to assume that they took $58,000 in dividends and no deductions whatsoever. What does that scenario look like? Now, from the dividend perspective, keep in mind that this assumes that it is a qualified dividend. Now, if you're interested in wondering what a qualified dividend is and what that even means, I'll go ahead and put a screenshot up here on the screen. And again, this is from NerdWallet. It tells you exactly what a qualified dividend is. So go ahead, pause the video, take a moment to read exactly what it is. But the biggest point here that I like to focus on, especially from a qualified dividend perspective, is the time. How long you hold that stock that provides that dividend for you. And as you can see here, it's actually not that long. So now, assuming your $58,000 is qualified dividend income, a single filer with no deductions, especially with those brackets in 2024, you'll see that 0% is actually paid on up to $47,025. So you pay no taxes on a little over 47 grand. Let's take the remaining amount. So if we did 58,000 minus the $47,025, that means we have a total of $10,975 remaining that we get taxed at 15%. And of course, you're seeing that with the brackets there. So what exactly does that equal to? Well, you have a tax bill of $1,646.25. That right there is the beauty of dividends, and also as well the tax savings that you get from those dividends. So essentially, your effective tax rate now is going to be 2.84%. So 2.84% taxes on your money because it's dividend income and it's not in a traditional 401k, or you can put it in a traditional 401k, get to the end of the rainbow, and it's treated as ordinary income, and then you can pay 13.5% on that money. And you tell me, which one would you rather do? I think the last reason that I'll give you why I don't use a traditional 401k is because you miss out on a lot of other tax savings that are much better than you would get with a traditional 401k that will allow you to have a higher net worth at the end of the rainbow. So what do I mean? Let's say, for example, you decided instead of investing in a traditional 401k, you decided to invest in real estate. Now, real estate has this really cool thing called depreciation. And for those who don't know what depreciation is, I mean, it is very, very interesting. So stick with me here. So in a nutshell, depreciation is a tax benefit. And what it allows you to do, it allows property owners to deduct the cost of a building over time. So think about, for example, this building that you bought and it has wear and tear. That wear and tear is factored in over time. So let's say, as an example, you have $300,000 that is invested into a real estate deal, and 60,000 of that is going to be the land, and then on top of that is the building, right? The building that sits on the land. So now you have 240 grand that is the building itself. That 240 grand can be depreciated over a certain period of time. And in fact, actually, let's go through an example together so that way you can see what I'm referring to and why this is so special. All right, so here's the scenario. We have the same person who is filing for single status. They're making $58,000, and that $58,000 is generated over a job, right? They're working a job like most Americans are. So that, of course, is W-2 income. Now, same example as before, we're going to take the $300,000 in that rental property that we were discussing earlier, and that is what we're going to use in order to showcase how this real estate depreciation thing works. Now, keep in mind, you can depreciate the building itself, but you can't depreciate the land, right? There's no wear and tear essentially on the land. It's really the building itself. As time goes on, you're going to have to do maintenance, right? Things are going to break, wear and tear. That is what is being depreciated. So let's say you have a rental income of $15,000 per year from this $300,000 investment. And I think that is very reasonable, and especially in today's market, I'd be shocked if I can find something for $15,000 over here that is not in the middle of nowhere. Now, let's say you have some operating expenses of $4,500 per year. Now, all of these numbers, they're a little bit below what the market value is today. To keep this example very simple, let's just go ahead and assume that these numbers are the actual numbers. And of course, as we did in our other examples, we're not going to take any deductions. So this is strictly just calculations based on no deductions. So the IRS says that you can do 27.5 years to depreciate the property. So what exactly does that mean? Well, that means that $240,000 that we talked about earlier, that is the value of the property itself, you can go ahead and depreciate that over 27.5 years. So what exactly does that translate to? So that translates to $8,727 per year. So this is the fun part now. Let's start calculating what your net income is on that rental unit. So you collected $15,000 in rent, but here's the interesting part. You're gonna minus now your operating expenses, which we said what was earlier? $4,500 per year. Now, on top of that, you're going to deduct the depreciation per year. And we just figured out that depreciation was the $240,000 divided by the 27.5 years that I have in order to depreciate. So that is $8,727. So even though you really made $15,000 in real life, you had some little bit of expenses, but that depreciation, that little magical thing that happened there, you actually on paper got to deduct $8,727 from your rental income. So essentially on paper, you made $1,772, even though technically speaking, you made a lot more than that. But on paper, it shows you made a lot less because of this depreciation. All right, guys, so step one, as you saw, we looked at what the depreciation was. Step two, we calculated what our net income is after depreciation, which was really, really cool. Now, step three is how does that apply to our W-2 income that we receive from our jobs? The same $58,000 that I made from my job, except this time now, my rental income, instead of saying that I made $15,000 after depreciation and net of expenses, I'm reporting that I only made $1,772. Essentially, I'm only gonna be paying taxes now on nearly $60K, not the $58,000 plus the $15,000 in rental income. Now keep in mind, if I didn't have that depreciation, I would have to report the $15,000 minus the $4,500 in operating expenses. So essentially, I would be paying taxes on closer to $70,000, more like $68,000, but closer to $70,000 than just slightly close to $60,000. So that depreciation helped me save so much in taxes. And by the way, I don't have to get to retirement in order to see those tax savings today. I can literally use that in my taxes for today while also increasing my net worth because I have rental income that is coming in to either pay off the house much faster and have that rental income coming in for the end of time, or I can take that $15,000 minus net expenses and go invest in another property and do the same thing all over again. Now, the other thing that I want to say real quickly about expenses is, can you actually have a loss when it comes to those expenses? And in our scenario, the answer is actually yes. So let's take our previous example, and instead of the $4,500 that we have in operating expenses, let's say the operating expenses now are $6,000. So again, we take our rental income of $15,000, we minus the $6,000 now in operating expenses, plus on top of that, we minus the depreciation that we have. And what was that depreciation again? $8,727. You now have a loss of $1,727 now. So that is what you would consider now a passive loss. And the IRS says that you can actually deduct up to $25,000 of passive losses when it comes to ordinary income. And that's only if your modified adjusted gross income is less than $100,000. Since we're only making $58,000 a year, you guessed it, we actually qualify for this. So exactly what does that mean now? The $1,727 is actually a loss that we can use in order to leverage that for our taxes. And now instead of $58,000 a year that we're gonna be paying taxes on, we're gonna be paying taxes on $56,272, which is actually interesting because we actually made $15,000 per year. And when you factor in how much we take in operating cost, so that's $6,000 minus the depreciation. So those two things alone allows us to not only continue to increase our net worth from a property perspective, but also as well, we pay less taxes today and we make more money on the back end because the house is worth more. You can charge more rent later on. I mean, the list is endless. And hopefully, guys, you were able to see how all of that works together. And that right there is 3 examples of why I don't use traditional 401k accounts. I don't think that they provide enough tax savings, if any at all, to be quite honest. And I don't see much of the benefits or the upside because at the end of it, I just showed you guys 3 ways in how you can see this. But The other thing I like to mention too is, as time goes on, typically taxes, they go up. And what does the government do when it comes to your tax dollars? You guessed it, they spend it on everything and anything. So if you ever take a look at what we spend in military expenses, Medicare, Medicaid, Social Security, all these programs, you'll see that over time, all those expenses just go up over time. And when you get to those golden retirement years, what would you rather have? Would you want your hard-earned money going to those programs, and those programs are funded by what is called your taxes? Or do you want to take that money and have it tax-free and enjoy the things that you want to do in life? Anyways, guys, I think that'll do it for this video. Go ahead and sound off in the comments. Let me know if any of this stuff doesn't make sense, or if you guys can think of another way that you can save on taxes. I mean, I think one of the biggest things that people don't realize is taxes is such a big thing. It's not about how much you make, it's literally how much you keep. That is what I've learned very, very early in life. So again, I'm interested in hearing your thoughts. Sound off in the comments below. And again, guys, that'll do it for this video. But as always, I love you. I appreciate you guys. Thanks for being here with me. And if this video has helped you out, go ahead and give me a like for the video. Make sure you subscribe to the channel and turn on your notifications so that way you're notified when I upload new videos to the channel, and especially when we talk about money. And lastly, of course, share this video with a family member or a friend so that way they can learn. Oh, and one last thing, guys. If you don't want to wait for my next video, YouTube thinks that you'll like this video popping up on screen. So go ahead and give that a watch. And until next time, guys, I'll see you all in the next one.